Uh, Hi everyone. Today I'm going to present on a big investment dichotomy which I generally have as to what I should buy, like very cheap companies where growth is not that high versus companies which are growing very fast but who are available at fair valuations. So I try to explain this and look at my own track record to see uh, which investment style has worked better for me and also get inputs from everyone about what they think. So just as a disclaimer, this is only for educational purpose. I'll be talking about stocks which I may or may not own, and you can just read the disclaimer. Uh, so some ground rules. When I say growth, I mean earnings per share growth. And when I say fast growth, I mean like more than 20% CAGR in earnings per share. Medium, I categorize as anything between 10 to 20%. And then slow is anything between 10%. Uh, in terms of valuation, you can use any valuation metric like price to earnings, enterprise value to sales. So any metric which is normalized and cheap is when the earnings multiple are cyclical lows. Expensive it's when it's at the cyclical highs, and then there is like a large band in somewhere in between. And I measure success by if the position generated IRRs of more than 20%, then I call it as a successful investment. So the underlying hypothesis which I'm trying to test is two case scenarios. So how the earnings are growing and what the valuations are. So the most easy case scenario is when the earnings growth is fast and valuations are low. And that over what I found useful for myself is like during those times, we should just load up on those positions. Then there are cases where the earnings growth is high, but valuations are somewhere in the middle. So in the average range, for me, what I use in this kind of a scenario is I have a model weight up to which I want to take a position. So until the valuations are fair and earnings visibility is high, maybe buy to the model weights. And if the EPS growth is high, but valuations also very high, I generally have a hard time deciding whether I should hold it or sell it. So buying at very high valuations is something where I don't go, but holding is something which I try to be more patient about nowadays. And then the other scenario is like when the earnings growth is low, what the decision should be. Where I really struggle with is in these two scenarios highlighted in red, where earnings growth is high and valuations is kind of fair, versus when earnings growth is not that high, but valuations are very, very attractive. So if I have two companies fitting these two criteria, what should I do? So I decided to look at it from my own track record of all the companies which I've invested in to see which investment fits in which criteria. I'm only showcasing my investment which for at least more than 1 year, and I've categorized each investment into high earnings growth versus medium earnings growth versus low earnings growth. So you'll start seeing these tables. So in terms of high EPS growth, I have so far invested maybe in 5 companies where the earnings growth was very fast, which meant like EPS growth was 20% plus. And as you can see, in most of the cases, the IRRs generated were quite high. Uh, there was only one case of Z Entertainment where the IRR was negative, and that was just not because the business was bad. It was just that there were certain corporate governance issues which came up. So my judgment on management was incorrect in that. What is more interesting for me is if I look at the EPS CAGR and the time when I first bought the share, like the price to earnings at that point of time, actually it didn't really matter. So even if I bought at 50 times, so for example, Davis Lab, I was buying in March 2019, and it traded at somewhere around 50 times multiples. But I held it for 1.5 years, and over that time period, my internal IRRs were 58%, so higher than the earnings growth. So I actually benefited uh, from price derating, although here it could look like the price kind of got derated a bit. But I also traded in between. So like during COVID fall, the stock also fell to much reasonable valuations, and I doubled my allocations at that point. That helped the IRRs. What I found for myself is like when the earnings growth is high, the hit rate is also quite high. Starting valuation surprisingly didn't matter much. So it didn't matter if I paid 17 times, and it didn't matter if I paid 40 times. The only lapse was when there was a corporate governance lapse, which was not a reflection of the business, but a reflection of scenarios which can happen to anyone in investing. So beyond business. So in the second case, I'm trying to summarize companies where I invested in. The earnings growth was kind of uh, average, so 10 to 20% EPS growth. And over here, the results have been kind of mixed. So there have been four cases where the IRRs have been around 20%, and two cases where the IRRs have been lower. And here as well, like if you see that the valuations ranged from 12 times to 30 times. The biggest loser in this case was Maruti, and that was just because I bought it at a I bought it in January 2018, so really at a cyclical high, and I paid a high price for it, so around 50 times earnings, and then I sold it a couple of years after at lower. So most of the stock underperformance was because of multiple derating. So in these cases, what I've realized is I have like a slightly lower hit rate, 2 out of 3, and I've lost most amount of money when I paid a very high price, and then the earnings growth was much lower than what the price I should have paid for. So my lesson in this is when you're buying kind of mediocre earnings growth stories, you cannot pay very high multiples to it. And then the third case, and this is the most interesting for me. So in these companies, the earnings growth was very flattish, so 0 to 10%. And surprisingly, the IRRs in all these four positions were quite high for me. In this case, math and alloys should be ignored because it's a pure cyclical, and I bought it at cyclical low earnings. So it might look like there was earnings didn't grow, but like if you just look 2 quarters after, this 79 EPS number became like 200 or something. So a lot of the stock price performance was because of earnings, but I just sold before the earnings started coming in. And that's something I realized for cyclicals. Market prices in the earnings before they actually start coming, and also market starts de-rating the company before the earnings start collapsing. So market is much ahead in understanding cyclicals. And then I have two examples of Infosys and HCL Tech, so very well-known blue chip companies, long-term tailwinds, mediocre kind of growth, and I have actually made reasonable IRRs in these. And my holding period has also been long. So for Infosys, it's been around 3 years. For HCL Tech, I held it almost for 5 years, and the IRRs were 40% plus. And in these cases, the multiples that I paid were kind of average or much below the average multiples that these companies trade at. Another case was of Bajaj Auto, where the IRRs were decent, 20% kind of. Earnings growth wasn't that high, but then the multiple that I paid was also not that high. So what I realized for mediocre earnings but blue chip kind of companies is it's not that difficult to make money in these, but you have to pay a reasonable price and hope that the market re-rates it at some point. And in these kinds of companies, buying and selling are equally important. So I also have cases where I bought them and then the earnings started degrowing. And surprisingly, I've made a lot of money in stories where the earnings have actually degrown. So companies like Vandala and Inox. So these were companies which I bought during COVID fall. So at that time, earnings looked high, but then like them malls were shut or their parks were shut. So I still generated decent IRRs because the prices became very attractive. And then I sold them even before the earnings started coming in. My biggest mistakes in this case has been Lupin and Shimaru. And in these cases, the earnings didn't just degrew, but the business really suffered a lot. Like Lupin, 5 years before I paid a reasonable multiple to it, but the profits has fallen completely. Like it used to do 2,500 crores of profits each year. Now it's doing 200 to 400 crores. So the business really deteriorated. And Shimaru was a similar case. The business dynamics completely changed. And I think you'll also get these. But what I want to highlight is EPS growth, even when it's negative and your holding period is 2 to 3 years, you can make a reasonable amount of money if you get just a sentiment cycle right. Like you buy during low sentiments and try to sell to an optimistic buyer. So and sell during a higher sentiment. So I've had a very surprising high hit run rate in negative EPS growth stories. So basically, it's possible to also make money when earnings degrew, basically paying very low prices. Two big misses, as I highlighted before, was Lupin and Shimaru, where the business landscape completely changed. This was my example, and I now wanted to also take Value Picker public portfolio example. So I have compiled, so Value Picker used to run a public portfolio sometime until 2014. So I picked all the companies that were in that portfolio and I looked at what happened if I held them until 2020. So this was an exercise which I did just after COVID. And what I realized was when you buy a lot of mid and small caps and you pay a fair price to it, but the earnings growth disappoints. So when I say disappoint, I mean like anything below 15%, the price to earnings can collapse or stay stagnant, and your price returns would not be that high. On the other hand, when the earnings growth kind of sustains, so this was the case of Astral Poly, where in 2014 timeframe, it used to trade at 50 times earnings. Even in 2020, after COVID, it used to trade at 50 times earnings, and the price returns were exactly same as the earnings return. So when you're buying mid and small caps, and you have to really get the earnings right, and the hit rate is also lower because getting the earnings EPS right is also kind of a challenge in these kinds of companies. So any company with EPS growth of less than 15% can suffer massive derating. My lesson for this is in small and mid caps, earnings growth is much, much more important. Whereas in large caps, which I showed earlier, earnings growth may not be more important. It's the street sentiment which is more important. That is, you have to buy when there is a bad sentiment about things and sell when it's more optimistic scenario. So for me, the conclusions are like if there is high growth and you are very confident in the next 3-4 years that the EPS growth will be upwards of 20%, valuation doesn't really matter. So even if I paid up to 50 times earnings in a divis, I made a reasonable amount of money. Same was the case of value pickup, investing in consumer companies. What I meant was consumer companies like Astral. Like Astral was also available at 50 times earnings in 2014, and the earnings multiple sustained because the earnings sustained. So for high growth companies, valuation doesn't really matter that much. For anything lower, valuation does matter and quite a lot. And what I found useful for me is for blue chips, buying at the lower end of the valuation band and then selling at the higher end is equally makes good amount of IRRs. And this is a slightly simpler form of investing where you don't have to really understand EPS growth dynamics, which is much, much harder to do. And in these cases, selling is equally important because you have to sell at the higher end of valuation. You cannot be married to a business. So this is like a short presentation, and I would love to get comments from others of what they think, what others' experiences have been in this.
Hey Harsh, this is Dinar here. Yeah, I joined late, but I have a question. So do you ever track things that might move into some of the indexes and re-rating because of that? So if someone's on the cusp of moving into a mid-cap index, and then it falls into MF buying kind of things. So do you sort of track that?
I haven't done that systematically. No, I haven't done that systematically, so I don't really know how that impacts stock price performance.
So I presume, if small caps wouldn't be in the range of MF investors, right? So I guess this very small caps, then PMS start getting interested, and then mutual funds start getting interested over a certain market cap. But I don't know whether you track that and that should sort of trigger some PE rating.
This is something I haven't worked on. So, for example, if a company enters into an SC 500, does that impact the multiples they get? I really don't know. What I saw in the 2018 to 2020 cycle was as you went down the market cap curve. So if you divided each company, so the whole index in groups of 50 companies, as you went down the market cap curve, each 50 companies after got a lower PE. And that was a function of a lot of regulatory changes which happened in 2018 and also in terms of markets sentiments. So what I found more useful so far is if you're expecting a bad market in the coming 2-3 years, you should be out of very small companies unless you're very sure of earnings growth. Because I think Rajan shows this chart every now and then where in good markets, the smallest companies go up much more, and in bad markets, they come down much more. And how would appearance in indices affect price to earnings is something I do not really have a good hang on.
Hey Ash, when you talk about the earnings growth, you talk about CAGR over many quarters, or can we just say jump in when the earning growths are like 20% after 2 quarters, or did you did some study on that?
No, it's really CAGR. So I just take the earnings when I was first buying uh, to the earnings when I was selling, like the last day I sold. Uh, and so the EPS on the day, so the trailing 12-month EPS on the day I bought, the trailing 12-month EPS on the day I sold. And then I have a column called how much time it was, like holding period, and then just computing the IRR. So it's not a jump per se, it's like just CAGR between two different points.
I mean, also if you could correlate, I don't know, I mean, I'm sure you haven't done it, but in case later, if you could do, for example, if Nifty is above say 200 SMA, is that, like then obviously we're in bull market, is that does matter or not?
I really don't know. Like for me, like the idea was to just answer one very simple question, which was what should I buy? Like high earnings growth at fair multiples or low earnings growth but very cheap. So far, what I've realized is I'm actually better at buying things very, very cheap. If actually I buy, if they are cheap and the business kind of stays there, but there can be a lot of work which can be done on more quantitative aspects as to try to understand share price movement in terms of multiple factors.
Hey Harsh, the first example that you showed where there is a growth of more than 20%. I think in your case, it looked like you bought them during the COVID onset or something, no? Especially the first
Not,
one.
it was only Nalco, but everything else you can see, like this was August 2018, this was March 2019, uh, again October 2017. So only Nalco was a COVID thing. Everything else
Okay.
is different from COVID. So this is like the first buy date, and this is the last sell date,
Yeah.
and then this is the duration.
Yeah, I was thinking if COVID was in play there, but okay, it was only for National Aluminium. Rest of them.
Yeah, it's only for Nalco, and also for Nalco, looking at PE is wrong because during COVID, like I think there was a quarter when the EPS went negative. So it's the PE is not even the right metric to look at it. Probably price to book is for these kinds of companies, and I remember it was trading at about zero point 0.4 or zero point 0.5 times book. So it was very, very cheap.
But the biggest challenge is how do you know in the future the company will grow at 20% growth rate, right? That you cannot judge, right? I mean, in the past, they might grow.
Yeah, so that's where the speculation part of investing comes, where you are, especially if you're trying to do high growth investing. And that's why I see a lot of people doing very well who focus on a high EPS growth during bull markets, and then they get crushed equally badly in bear markets. Because sometimes business cycles, so one thing is earnings momentum, one thing is price momentum, and then there are a lot of people who try to marry the two. What I generally feel is business momentum is generally lasts for 2 to 3 years for most businesses. So I mean, when I say business momentum, I mean very high earnings growth. So like earnings doubling in 3 years. There are very, very few businesses which can keep on doubling that in a in a moving average kind of a setup. So they will always go through a phase of high growth, and then there'll be a stagnation, and then there'll be another period of high growth, and then there'll be another period of stagnation. So that's how most businesses kind of evolve, and making a judgment. So looking at it from a historical perspective, that is, in the last 2 years, the earnings growth was 50% CAGR. I think that's a recipe for disaster, because generally when the earnings growth in the recent past is very high, that means business momentum is already very hot. And just like price momentum doesn't last for a long time, business momentum also fades away. There are very few businesses which can sustain 20% plus EPS growth. They can do 20% EPS growth over 20 years, but the growth would be patchy. So in certain bursts of the cycle, they'll have 40% EPS growth, and then they'll stagnate for a bit. for 2-3 years. So that's where I I also struggle with like how to get the earnings cycle right. But the point is, if you get it right, then starting valuations really doesn't matter. And I've not only done this work for my portfolio of value picker, but I've done it for a lot of other businesses which I also analyze. So if the earnings growth, like if the earnings actually doubles in 2-3 years, starting valuations doesn't really matter, at least in the Indian market context.
Hi, Harsh. I had a little question around this. That let's say that a business is going through a lean phase, and there has been almost stagnant or negligible EPS growth over, let's say, the last 3 or 4 years, and then suddenly, obviously, the companies are trying to do something, and they're trying to, create a new set of cash flows, a new set of businesses, and maybe they're trying to grow, and then, but then it's very difficult to maybe initially predict that, okay, 5 saal se nothing has happened in this, but now it will start happening. Or maybe you'll have to wait for at least 2 or 3 quarters, or maybe some results when you actually start to see that EPS growth and that's coming about, and actually the business is now entering again into an accelerated phase or something. Any thoughts on that?
So there are 2 ways of thinking about it. One is, when do you want to catch the growth cycle? Is it when the valuations are very, very attractive and you think that the growth will come in the next 2-3 years, but maybe not in the near term? So where the near term is a bit hazy, but you're confident about the medium term, that the growth would be there, then you can get very, very interesting valuations. And for me personally, what I found is the highest IRRs are when you are able to live through that consolidation. Let's say you're not sure of when the earnings will start coming in, but you're reasonably sure that in the next 2 years, it will come in because the factory is about to be commercialized, or there's a big product which is about to be commercialized. And if you're able to buy towards the cyclical low end of the valuation, then you get the benefit of both re-rating and EPS growth. And then there's another philosophy, which is like, you want to see it evident in numbers, like the earnings has to start growing, and you have to see that, and then you have to get in. So over there, obviously you will get less benefit of re-rating because there'll be certain market participants who would be tracking the business in a much better way than you are, and they would be earlier in the ship. So a part of the re-rating would already have happened. So you might be late to the ship. What I found actually useful in these kinds of scenarios, where the earnings are already coming in, but the price has also gotten heated up, you just hope that something bad happens in the world, and then the price becomes attractive. For example, in the case that I highlighted of high EPS growth, like Divis Lab was a typical case where the street saw that the earnings started coming in. I think the earnings started improving somewhere in late 2019. And then COVID fall came. So the valuations, like, although in 2019, March, it was, I don't know, how much was it? Yeah, 50 times, but it went down to 25 times or something. And over there, you have a very, very good clarity that the earnings are coming, and now you're getting it at a reasonable price. And then it becomes a no-brainer. So if I had just started buying in March 2020, this IRR would have been even higher, and much, much higher actually. So then if you want to see it evident in numbers and still maintain very high IRRs, you have to hope that something bad happens in the world, that the whole market is collapsing. Other than that, I have never been able to buy a story when it's already started running in. So like, it's very hard to get on a bus when it's already left the stop. It's easy to get in when the bus is already standing there, and you can do all the work. You can try to be sure. One good thing with this strategy, when you are getting on the bus when it's still stopped, is your downside is very low. So even if the earnings growth doesn't come in, there will be an opportunity loss, but there won't be actual capital loss. Like it's very hard to lose money on good businesses if you buy them at lower ends of their valuation, and then you hope that the earnings come in. In the other case, if the earnings for some reason stops, if the earnings growth, then there can be massive capital loss as well. So when you are getting on a running train, then it's doubly important for you to be sure of earnings coming in.
Perfect. That sounds quite reasonable. Thank you.
What has your experience been, or what has anyone else's experience been in this?
For me, is it okay if we open Screener and look at a company for a slide case or something?
Oh, sure. Do you want me to open it, or?
Yeah, you can open it.
Okay, perfect.
Or should I continue recording, right?
For me, it's okay. Is there a problem for anyone else?
I continue.
Okay. What company do you want me to type?
Yeah. So, for example, let's look at a company called KSB Limited.
What do you want me to look at?
The EPS, annual EPS numbers.
Mhm.
I can only see the presentation right now.
Oh. Yep.
Yep.
Do you still see the presentation, or do you see Screener now?
I think we can see the Screener.
Okay.
Okay. So this company says that by December 24, they plan to do a sales revenue of 2,200, or roughly an EPS of 60, around 60. So this is going to be a 20% EPS growth from now on, as per company, for the next 2 years or something. But obviously you can see that we have already missed the buzz quite a lot, because some re-rating, I think, should have already happened if you just look at the numbers. So
I mean, you can look at the stock price stage here, right, on the bottom.
And we can just look at what kind of re-rating happened. Yeah. And maybe the market is building up another re-rating. Like the market is already seeing that earnings is coming up. That's why it's probably trying to go up.
yeah, the results happened recently, and yeah.
No, but
but already the 20 EPS, which was in green phase, has become 40. That was my case. But,
yeah, that's generally the problem. The market, like there are enough people in the market who knows the company better than, let's say, someone who's just analyzing it, looking at numbers. They might know people working there and stuff, so they can front run you. And that's what I've seen. So it's much easier to buy when the earnings are consolidating, as in like you'll get very, very good prices. But once you miss the boat, it's very hard to get in. For example, let's look at a company where the earnings consolidated for a long time, where the stock price, let's say, consolidated for quite a long time. And then, so if you look just in terms of earnings chart, so first of all, let's look at longer term earnings, what happened. It was okay until FY17 when the Chinese problem came in. So basically some industry dynamics went bad. And then there was earnings consolidation. So the EPS kind of stagnated at 20 rupees. And then the first signs of change came in FY21 when the EPS started growing. If you look at the quarterly numbers, you would really see that something started changing around just after COVID. And then like the earnings, like the sales growth kept on coming. And so the market really recognized this only quite late. If you look at in terms of price chart, the market only recognized it somewhere around this time frame that earnings is actually coming. So if you look at the stock price chart, like it never really re-rated, even when the earnings had started coming in. Like it only re-rated after, let's say, December 2021. So like 5-6 months back, when the market started really believing that the earnings growth is sustainable. So that's my point. Like a lot of times you have this kind of time period when the earnings, you start seeing the first signs, but the market still doesn't believe it, that the earnings growth is sustainable. And I find like this to be much more opportunistic. And the easiest is when you are buying towards the lower end of valuation and hopefully also the lower end of the earnings, because then you're buying at a very, very cheap price. So in these cases, you can make a lot of money just out of re-rating, even if the earnings doesn't come in. So that was what I was saying. Like when you buy at very, very low multiples, your downside is very protected. And then you just have to hope for the upside. And then it's very hard to start catching it once the earnings start coming in. And then you have no idea what the right multiple should be. And as long as Street has a good idea of how the earnings would grow, they would not derate the stock. So as long as the earnings keep growing, you will be rewarded. But once the earnings, so another example here is Ajanta Pharma. Like this is a very classic case where the earnings kind of stagnated at around 400, 500 crore levels. So EPS of 50 rupees. And then in FY21, the earnings started coming back in. And if you just look at the stock price chart long term, this is where the earnings kind of peaked, price also peaked, and then there was a huge room of consolidation. And then since then, like this was the period when the market really recognized that earnings growth is there, and it kept on re-rating. So if you look at a price to earnings chart, and it kept on re-rating, and then like now the market is again doubtful of how the earnings could be. So it has kind of taken its valuation down to long-term average levels. So again, when let's say 3 years down the line, earnings doesn't come in for Ajanta and it's available at these valuations or maybe slightly lower, I find that to be much more reasonable valuations, because then your downside is very, very protected. And you have no idea about the upside. Whereas trying to get somewhere here, it's very painful, because let's say you got over here at 30 times multiple, and now you are struggling because you are back at 20 or long-term multiple. So sometimes multiple derating can take away a lot of stock price returns. Like this is a classic case of ICICI Lombard. I don't know, the IPO came in 2017 or something. And if you just look at the price to book chart of this company, it came at 7 times, it went up to 10, 11 times. Now it's back to the IPO valuations of 6, 7 times. So the IPO investor has still underperformed the market by holding the best insurance company. And people who got in at 10 times, they are massively underperforming. So I find it easier to buy towards the lower end of the multiple range. What is others' experiences been in this?
No, but isn't it completely based on what your perception of PEG is, right, compared to what the market is? So it could go even lower, or depend. So I think it's really the differential between what you think is growth rate valued at compared to what the market thinks, right? And that's the differential you make money.
If the earnings growth doesn't come in, like it's very, very hard to justify any multiples. Like
no, but you can justify like 10 times, which is the cost of capital. So or 10 or less times, less than 10 times, right? So if the yield just so like for example, Power Finance is giving 10%, right? So your downsides pretty much zero. So even so you can so I think cost of capital, you can, depending on your cost of capital, you can say that zero growth is this, and then but the way I see it is, I sort of draw a probability chart saying that between best case scenario, mid case, and the worst case scenario, and assign some probabilities to it, and then work backwards towards So I would say, what's my downside, and and assign some probability to it. What's the upside here? I also factor in risk, and like I don't know whether you take into account like the total addressable market, competition, and risk. So for example, like food services companies like Jubilant and things, right? One bad food scares could in the US and things, Chipotle and things had bad food scares and that kind of affects it. Whereas someone who's doing something less, or like drug companies, right, selling to the US, like one bad FDA inspection could so I don't know, I sort of take into so maybe those are the factors you need to take into account as well as to
also this is much easier said. Like when we talk about probabilities, and if we really want to be correct in our judgment, then we should actually look at what the probabilities we assign and how often it actually happens. So at some point we can assign probabilities, and whatever to it. But then we have to be rational as to say how often my assessment of probabilities were right. So if I assign something a 90% probability, then I also have to look back, whatever I assigned 90% as a probability, did it happen 9 out of 10 times? Or let's say if I took 100 decisions, did it happen 90 out of 100 times? Or something like that. And that is something that I find very, very hard to do. Sorry, go on.
No. And sometimes the market kind of doesn't factor into account, competition will come in, right? Where there is like above average returns, like say diagnostic companies, right? And low barriers to entry. Competition would come in, right? So sometimes the market doesn't
to separate the lower end from the highest end. But then everything in between, it's very, very hard to say. Like, as you said, power finance at 2 times earnings, what can you lose? Is one way of saying it. But then trying to...
Yeah, that's the easy thing to do, right? Yeah, but you're right, in the middle case here.
Or like another example I would like to give is HDFC AMC. It's a well-pedigreed name. What is the multiple which you would like to give to it? Like it debuted at a 50 times multiple, right now it's at 25 times multiple. Is 25 times correct? Is 50 times correct? Is 10 times correct? So, and anyone who's riding from, let's say 70 times to now, they would think of how badly this company is done.
No, but you'd also look at, you'd also look at what I do is also look at like, foreign asset management companies at what multiples they trade at here.
But if you use that, then you cannot buy any financial in India because no asset manager abroad trades at more than 2% of the.
No. So no, you have to. Obviously, you have to factor into account that India would be mutual fund sahi, and then amount of funds are growing in, right? So so twice as much.
I've looked at all the global financials. None of them trade at.
But definitely, I would expect Indian ones too, because India is growing. Its GDP would grow twice as much as any of the foreign ones. No, I'm saying I just take into account one of these would be a few factors. But like the way I see it is, it's 25 times. The tailwinds. The asset management industry would grow, but there's competition as well, right? So I guess it would be fairly valued. Like if someone like Zerodha is, so if you look at all the emerging economies, right? People tend towards. So how much money HDFC, is it all performance management fees it makes it on?
Yes. As expense ratio.
So the like my thesis would be, the market's growing, but effectively, if you look, what happens is people tend to invest in index funds because, once right now India is growing at like 15, corporate earnings growth is 15%, right? So at 15% to give 1% to active managers is worth it. But when your economy is growing at 6%, then people effectively most of overseas, everyone does invest in index funds, right? So then the margins would reduce. So I guess 25 times would be a decent thing, given that it's growing, but there's competition increasing.
Also, what I found is a lot of Indian businesses actually do not grow at much higher rates than their foreign counterparts. For example, I remember looking at Suzuki versus Maruti's earnings growth. And I was very surprised to see that Suzuki had a very similar earnings growth. It just trades at a much, much lower multiple than a Maruti. And I think that's just quirks of Indian markets. Like I think it's just a few fund managers who get a lot of money and they have to deploy it somewhere. And then they have to paint a narrative to make the investors happy. Like HDFC AMC, we can clearly see that in the FY17 cycle, it did much, much better than like the biggest asset manager, who also did well. Like here, in this case also, I think the earnings CAGR was around 12%, which is not low, but HDFC's was much higher. I think HDFC's CAGR was around 19%, something around that. So for sure, it deserves a premium multiple. So two questions which always comes to me is how much premium and for how long can they actually grow faster? Because I've seen a lot of big Indian companies, if you account for the differential in US to Indian dollar. So like if you just take the 4% differential into account, a lot of Indian companies do not grow very, very fast compared to foreign counterparts. Maybe in terms of US dollar terms, 3% higher. And for 3% higher growth, sometimes we pay like 5 times more multiples. So that's something which I find very, very hard to justify. For example, like if you look at ICICI Lombard versus a Prudential insurer of UK, Prudential actually grows faster than ICICI Lombard and rates are cheaper valuation than ICICI. So we can find these discrepancies quite frequently in the market.
What I don't get is, like large companies, Asian Paints and things, like their multiples are like, because already like the paint market, isn't it saturated? Or I don't know the specifics, but so people are betting on Asian Paints going to another market and doing the same thing, which is kind of hard. Unless the paint market isn't saturated.
Yeah, it's still not saturated. So there's still 7-8% volume growth. Over that, they take 3-4% pricing improvement. And then over that, they take 1 or 2% higher cost efficiency. So Asian Paints like grows EPS at 14-15%. And then like the market kind of re-rates them all the time. But I've been surprised that Asian Paints growth is not that different from a lot of FMCGs. For example, ITC's growth rate or ITC's FMCG division's growth rate has been higher than most FMCGs in India. But yeah, it's just that time frames sometimes are different. If you go back 20 years, then Tata Steel's growth rate has been exactly the same as Hindustan Unilever. And Hindustan Zinc has given higher dividends than Hindustan Unilever. So if you go really long periods of time, then it really doesn't make any difference in terms of growth rate. I'll stop sharing my screen.